All right, so Broadcom, ticker symbol AVGO, just reported earnings, and the market's going crazy, now up over 22.44%. And at first, the results don't look that nuts. They missed on revenue slightly and beat on earnings per share by 2.9%. However, like most things, you have to look into the details, and the market liked a lot what they heard on the Q4 earnings call, most notably the 2027 outlook given for their AI semiconductor business. Other big news included an 11% increase to their quarterly dividend payment. This adds to Broadcom's long history of dividend growth, and it's that dividend growth, free cash flow growth, and earnings growth at Broadcom over the past decade that has led to fantastic returns for shareholders. The 5-year total return for Broadcom stock is 718%. That's a 52.2% compound annual growth rate. The 10-year total return is 2,832%. That's a 40.2% compound annual growth rate. And since going public in 2009, the total return for Broadcom stock is 18,920%. That's a 40.7% CAGR. So in hindsight, this is one of the best stocks you could have bought over the past 10 to 15 years. And it was a favorite among dividend growth investors since around 2016 to today. However, this is a company I was wrong on multiple times. I was way too late to invest into Broadcom when I should have done it. Given prior knowledge, I should have been buying the stock all the way from 2020 through early 2023. It matched all the metrics I look for, including high and growing free cash flow per share. At that time, it traded at an incredibly low free cash flow multiple between 10 and 15 times, which in hindsight looks insane. This is a company that consistently traded at a low multiple, but they used that free cash flow to reward shareholders and use it towards new acquisitions as well. They also did that through debt. You can see they would have these spikes in debt every time they make a new acquisition, then they slightly pay it off, and then they lever up again, slightly pay it off, lever up again, slightly pay it off. And most recently, they had their VMware acquisition where they levered up a ton and have slowly started paying it off again. But my point is that it was obvious that Broadcom was a good buy for a while. And my reason for not investing in it was that I did not understand their business model at the time. However, in spring 2023, I did a deep dive stock analysis video on Broadcom, and I finally added the stock to become a large part of my dividend growth stock portfolio. And at that time, that investment thesis had very little to do with AI because Broadcom's business had very little to do with AI. However, over the following year and a half, Broadcom stock soared in value, and I ultimately ended up selling it after 200% gains in less than a year and a half around June 2024. And my reason for that was that I think the market had gotten ahead of itself regarding Broadcom stock and its AI business. And I made a full video detailing my thoughts at the time. However, I did not say that I thought Broadcom stock was going to go down anytime soon. And it looks like the stock just popped again to all-time highs, now up to 23% on the day. So I'm going to dive into Broadcom's latest earnings report, do a full picture business and stock analysis, and ultimately share what I got wrong with Broadcom stock and whether I think the stock is a little risky at these all-time highs, just crossing a $1 trillion market cap. If you stick around to the end, I'll share some analyst price targets on Broadcom stock and do a brief discounted cash flow calculation to estimate the intrinsic value of the company. If that sounds good, let's buckle up and roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using my stock analysis tool over on dividenddata.com, which in my opinion is the best tool on the market. We have our new AI analyst where you can ask really any financial question you need about a stock, and you can use that to summarize earnings reports like I will today and get a detailed look at key business metrics, and it can also help you do discount cash flow analysis. Plus, it has a great stock analysis tool with data visualizations that allow you to get a full picture look at the financials of a business. And it even has important metrics specifically for the dividend growth investor. If that sounds interesting to you, you can sign up today at dividenddata.com. So we have Broadcom, ticker symbol AVGO. Current stock price after this 23% boom is $222.64. And based on GAAP EPS over the trailing 12 months, they've only had EPS of $1.28. But guys, I know that's not the full picture. We'll explain that in a bit. That uses net income, which was unusually low in fiscal 2024 for Broadcom. And with the new 11% dividend increase, the annual dividend for Broadcom is now $2.36 per share. That gives it a 1.06% dividend yield at current prices. And on a historical basis, that is the lowest starting dividend yield ever for Broadcom stock over the past decade. And to highlight again what a good deal Broadcom stock was for a long time, it reached a peak dividend yield of 7.74% during March 2020. And there were 5 years where it ranged between a starting dividend yield of 3 to 4%. Again, when I bought the stock in spring 2023, you could have still gotten a 3% dividend yield for Broadcom. And if we take a big picture look at their key financials, you can see that revenue per share has grown at a 20.69% 10-year compound annual growth rate. And this has remained high in the past 3 years with a 3-year CAGR of 18.55%. And on a per share basis, their revenue increased 29.23% in fiscal 2024. And a lot of that was from their VMware acquisition, which I will soon explain. But what's interesting is that a lot of that revenue has not been accretive to free cash flow. If we take a look at net income per share, they actually just had one of their worst years in recent history. But a lot of that was due to one-time write-downs post the VMware acquisition. The real measure of a business is their cash from operations and free cash flow, and Broadcom has been a free cash flow machine for decades. However, on a per share basis, their free cash flow is actually down 1% over the past year. Still, the 10-year compound annual growth rate of free cash flow per share is 29.97%. This has slowed down though with a 3-year CAGR of 8.92%. So this is interesting and a lot of how I was thinking about Broadcom stock. Notice $4.20 of free cash flow per share. No growth on a per share basis year over year. Yet just in that time, Broadcom stock was up over 100%. Oh, and by the way, guys, when I get to the earnings summary for Broadcom stock, you will see that a lot of the raw numbers have increased a lot for Broadcom. But this is why I think it's so important to view things on a per share basis. Broadcom spent a lot of money acquiring VMware. So one of the things that happened there was a massive increase in debt. They went from $25 billion net debt to $64 billion net debt. But the other thing that happened is they diluted shareholders. There was an 11.9% increase in shares outstanding. So in the earnings report, you'll see them saying that they had a huge increase in revenue, but on a per share basis, it was lower at 29%. And if we take a look of how that funneled down to profits, it was far less. Still, Broadcom has been a great dividend growth stock over the long term. 5-year CAGR of the dividend is 12.67%. And based on free cash flow, the dividend is consistently sustainable at 50% in fiscal 2024. And it has been in this 40% range for much of the past 5 years. And again, in the short term, based on net income, it will look like it was unsustainable in fiscal 2024 in terms of payout ratio at 166%. But keep in mind that is a lot of outlier data, which is why I think it's so important to look at payout ratio based on free cash flow. And it's why I specifically built that into the stock analysis tool on dividenddata.com. All right, so now I'm going to summarize their latest earnings call and give all the highlights, the stuff that made the stock boom, etc. But then I'll also take a look at how their actual business is broken up, what are their largest business segments, and how big is AI really in Broadcom's overall business. Q4 2024, Broadcom reported record revenue of $51.6 billion for fiscal 2024, which is a 44% increase year over year. But here is the most important part. It says including the VMware acquisition. Excluding VMware, organic growth was only 9%. And if we scroll back down here so you can see their revenue by product segment, you can see that they have semiconductor solutions and infrastructure software. Those are their two business segments. And prior to the VMware acquisition, Broadcom was 78.8% semiconductors and 21.1% software. However, in the latest quarter, semiconductor solutions was only 58.5% and infrastructure software was 41.4%. And you can see this big jump in total revenue when the VMware acquisition happened. And since then, they have been slowly adding, but it should be noted that semiconductor solutions just hit an all-time high in the latest quarter. That was up to $8.2 billion billion of revenue. And the reason why is that they found a new growth business in semiconductors, and that is in AI. Their AI revenue grew 220% to $12.2 billion, now representing 41% of their semiconductor revenue. So that is 41% of 58% of their business. So we can think about this as about a quarter of Broadcom's overall business. So at what's now a quarter of Broadcom's business is growing very fast. And that AI business is included in their networking products segment, which has now become their largest semiconductor segment. And that grew 45% year over year, driven by a doubling in AI XPU shipments and 4 times growth in AI connectivity. So that was in their existing Ethernet business, which they use to support data centers. And then their specific AI chip is the AI XPU. So AI has created 45% year over year growth in networking revenue, which is great. That's awesome. But one of the things that made the stock boom is they gave long-term AI outlook. Broadcom estimates a serviceable addressable market of $60 to $90 billion by fiscal 2027 for its AI semiconductor business. So they're at $12.2 billion now, and they expect it could get to $60 to $90 billion. So in fiscal 2024, total semiconductor revenue for Broadcom was $30.1 billion, and AI accounted for $12.2 billion of that. So that's 40.53% of their semiconductor business. And the big question around Broadcom stock is how much that AI business can continue to grow. And this $60 to $90 billion target by 2027 gave a lot of hope for the market. Because if we just take the lower end of that, say $60 billion, then that would be doubling their current annual semiconductor revenue. And the other part that's great about this is Broadcom's other semiconductor businesses are actually pretty bad and declining over the past year. And that is still the majority of their semiconductor revenue. But if this growth business starts to dwarf all of those other revenues and hopefully even their software revenue, then Broadcom may be in for business and the stock could continue growing from here. It should be noted that they use the term serviceable addressable market, and Broadcom does have competitors, so they would likely not capture 100% of that addressable market, but still that line is the entire reason why Broadcom stock is up 23% today. Other highlights for the quarter, free cash flow came in at $5.48 billion, which is really good. Also, I'm going to bring up here another structural reason for why I initially invested in Broadcom and why it's such a free cash flow machine compared to a lot of other semiconductor companies. And that reason is because it's a fabless semiconductor company. They do not do the manufacturing. Broadcom is a chip designer and they get it manufactured by third parties. So what that means is they have much lower capital expenditures compared to a company like Intel. In fiscal 2024, they only spent $548 million on capital expenditures. So that means of their $19.96 billion of cash from operations that year, $19.41 billion went to free cash flow. And into this principle, which has powered their dividend growth and their financial ability to continue making large acquisitions, even though they use debt for that as well. And another great example of a fabless semiconductor company is Nvidia. They are able to convert basically all their cash from operations into free cash flow. And that's why Nvidia has become such a free cash flow machine. However, I want to point something out here. As we compare Nvidia to Broadcom, it becomes painfully obvious which one is the real growth business right now. Even after Broadcom saw their AI revenue grow 220% year over year, it is still less than a third of Broadcom's entire business. Where if we look at something like Nvidia, 87.7% of their current revenue comes from their data center business, and the entirety of that data center business is AI related. And in just 2 years, that business has gone from $3.8 billion to $30.7 billion of revenue. And that has generated $56.54 billion of free cash flow over the trailing 12 months and $16.8 billion in the latest quarter. Broadcom has seen its stock explode as though it is Nvidia. But the reality is AI is a much smaller part of Broadcom's overall business. And Broadcom's valuation, especially when you compare it to a company like Nvidia, it's starting to get a little nutty. Current free cash flow is $4.20 per share. You know, this is so funny too. As I'm talking, the stock price keeps going up. It's now at 24.92%. So that gives Broadcom a free cash flow multiple today of 53.73. Nvidia's free cash flow per share over the trailing 12 months That is $2.31 per share of free cash flow. So that means Nvidia, based on today's stock price, is only trading at 57.8 times free cash flow. And if you are buying Broadcom today, thinking that it will have higher growth than Nvidia, and your bull case is all around AI, then you are legit crazy. Basically, 90% of Nvidia's business is directly AI related, and it arguably is going to grow faster than Broadcom's AI business. But Nvidia only trades at a slightly higher multiple. So in my opinion, looking at this, it's obvious that Nvidia would be the smarter investment than Broadcom at current stock prices. And especially after this 24% increase in Broadcom's stock price, I'm personally less interested than ever as having it a part of my portfolio. That said, if you were one of these people who bought it anytime over the past decade and just have continued holding and reinvesting your dividends, you'll do fine. This is not a message to sell Broadcom stock, but it's my opinion that the stock price has gotten a little ahead of itself. But I don't think Broadcom stock is actually horribly overvalued. I just think it's going to be difficult to get strong returns from here over the long term. Let's take a look at analyst price targets, and then I'll do a discounted cash flow analysis on the company. The average price target on Wall Street is $209.89, which is sizably below the current stock price of $225. However, the highest price target on Wall Street is $260. So from the most bullish analysts, they're still is upside, and analysts are definitely on the bullish end of the spectrum for Broadcom. The consensus recommendation of all brokers on a scale of 1 to 5, with 1 being the most bullish, is 1.46. 29 say buy, 8 say outperform, 6 say hold, and 2 no opinion. All right, so now I'm going to do a discount cash flow analysis, and by the way, you can go on dividenddata.com, type in any stock and discounted cash flow, and it'll bring up this calculator. You hit show more, and it autofills with all this data, and then you can adjust the growth rate for all the key metrics. And also after that, I thought it'd be a fun idea to do a sum of the parts analysis too on Broadcom, given that their AI business deserves such a high multiple compared to their other segments. So I'll do both. All right, so by default, the metrics associated with Broadcom, it gave it an implied share price of $137.53. So that's massive downside. That's assuming 18% revenue growth in fiscal 2025, 12% growth in 2026, and 12% growth in 2027. So let's be a little more bullish and put in 10 for 2028 and 10 for 2029. The other key assumption here is an exit multiple based on free cash flow. So what the stock would be trading at based on free cash flow. It has that at 20.95, which is historically probably a very accurate one for Broadcom. But given their higher growth, I don't see this as likely. Given that AI is becoming a larger and larger part of their business and the growth rates of that segment are pretty high, probably safely increase this to 35. So that makes the estimate way more bullish and gives an implied share price of $257, which would be upside from here. But as I'm looking more and more into this calculation, I think the default EBIT margin they had was way too high. On an annual basis, they've never hit low 60% EBIT margins. And you can see here in this unlevered free cash flow section, it boosts it way too high. So that bullish calculation, in my opinion, not accurate. If we lowered that down to 45% for each year, which I think is a more healthy estimate, that still implies free cash flow growing to $28 billion all the way to $37.7 billion by 2029. So I think that is a bullish estimate itself. That gives you an implied share price of $183.53. So with what I would say is a bullish estimate, you basically wipe out all of those gains back to when I sold in June. And that's a pretty bullish valuation. If we do a sum of the parts valuation, which is pretty interesting, I asked my AI analyst to basically break out all the different product segments and break out the AI semiconductor business from the rest of their semiconductor business, and then assign a revenue multiple to each. So I had the current AI segment revenue at $12.2 billion at a revenue multiple of 15, which would imply $183 billion value to that segment. It had the other semiconductor businesses at 17.9 with a revenue multiple of 8, which would imply a $143 billion value. And it had infrastructure software at $21.48 billion of revenue with a 10 times revenue multiple, giving it a value of $214.8 billion. So summing all of those up, that gives it a value of $541 billion, subtracting the net debt of $58.22 billion, and it gives you an implied intrinsic value of $482.78 billion. and Broadcom's currently trading at over a $1 trillion market cap. So that would say it deserves to be cut in half. But let's get very bullish with the AI semiconductor segment. 15 times with how it's currently being valued in the market, that could be as high as 30 times, which would up the value for that segment to $366 billion, which would then bring the total valuation to $665 billion, which after today's 24% increase in stock price, it starts to get a little nutty. So my main takeaway with today's analysis is that Broadcom is a very high quality business and was a great investment opportunity for decades. But now the valuation may have just gotten far too ahead of itself. And I really have no idea, looking at Broadcom stock today, how over the next 10 years, they could have as good of a total return that they had the past 10 or even 5 or even 3 years. Over the past 3 years, Broadcom stock has gone up 288.99%. Is Broadcom going to be a $3 trillion company anytime soon? I really don't see it. I would be happy to be wrong though. And I definitely wish I had bought way more Broadcom earlier in my dividend growth portfolio. But hey, that's what we do here. We keep learning from our old mistakes and getting smarter one day after the other. So if you enjoyed this video, leave a like and subscribe to the channel. And most importantly, if you want to use any of the stock research tools I showed throughout the video, it's all available at dividenddata.com. Link in the description and pinned comment. And that's it. So I'll see you in the next video.